Good evening, guys. I'll just give about 5-10 minutes for everybody to join since it's the first session. So people might have issues with, and stuff. So I'll just give them a few minutes and then we can start. Okay. Just welcome everyone. I'm just waiting for about 5-10 minutes. Okay. So in case anybody wants to join in, they can. I don't want to start and, have to go back and come again and things like that. But I will start at about 6:10. Okay. Latest. So meanwhile, I know who Yunus is. The rest of you, that is Amina and Shagana, you can, if you're comfortable, you can introduce yourself. Okay, you can tell me, where you took lectures. Are you sitting for the paper in March? Are there any areas that you specifically want to cover? Okay, so those kind of things, you can unmute yourself or you can drop it in the chat. Yunus also, yes, he's one of my students online. So if again, Yunus, you also have something to say, you can always drop it in the chat or unmute yourself. Okay. Yes, so those coming in, welcome to your TRG. We will be starting in about 5 minutes. Okay, I'm just trying to give everybody a chance to join in since it's the first class. But definitely next week onwards, we have to next week onwards we have to start on time. Okay. Okay, so some of you are here who are not doing exams in March. That's fine. Okay, so if you're here, if you're not doing it in March and you're here, then first thing is you are definitely in the right path. Okay, because you probably will be sitting in June, and if you're thinking about papers now itself, then that's a good sign. Okay, that's always a good sign. So this particular TRG and all the TRGs to follow as well, we will focus on papers. Okay, because end of the day, when it comes to FM, it's all about papers. Okay, so the entire month, we will be doing as many questions as we can. Don't worry, I'll give you a formal introduction and stuff. Just let's give the others about 3 minutes and then we can start. The rest also, if you want, you can introduce yourself. Okay, let me know. Even if there are areas that, you want to cover, let it be risk management or whatever it is, if you feel that it will be good if we, do more questions on that area, let me know. I will see if I can accommodate that. Okay, so I guess I'll start before you guys get bored. Okay, right. So the TRG, welcome to it. Okay, today is the 6th of February. So if you are sitting for papers in March, you're talking about a little more than a month remaining. Okay, because the exam is on the 8th of March, if I'm not mistaken. So you have today is the 6th, so next month 6th, and then a few days after that as well. A day actually. So first things first, is this time enough for you to pass FM? Okay. Let me be frank with you. I will definitely not sugarcoat anything. Okay. I'm not going to say something is possible when it is not. Okay. So I'm telling you 100%, yes, you can pass FM. Not even pass. This is enough for you to even get a world prize. Okay. Definitely 1 month is the maximum because even if you're studying for 2, 3, 4 months at a stretch, the final month, okay, the month in which you're going to remember what you learned, that is this month, February. Okay. So this is enough time, even if you're at 0%, you don't know anything about FM or you went for the lectures, you can't remember. Okay. Don't worry. In fact, that in some cases, that can even be an advantage to you. Okay. Because you at this point, you're going to learn everything from scratch. Okay. But I'm telling you this, you will hear me saying this only today. Next week, if you come and ask me, I'm at 0%, is it enough for me? Then I will tell you it is enough only to pass. Definitely not enough for prizes. Okay. You ask the week after that, I will say it's enough to pass, but that also it will be a scratch. Like, you'll be able to get 51, 52. Maximum you'll be able to get 55 if you're going to study for 2 weeks. Okay. You come and ask me the last week of February, is it enough? Then I will say, I really don't know. Just pray to God and, make sure that some miracle or something happens. At that point, it's better to pray than to actually, study because FM is a paper like that. It's not a paper where you can, sort of, load your brain with all the information and then go and vomit it onto the paper. It can never happen for FM. Okay. Because the reason for that is you have to have a foundation. Okay. You have to have a basic foundation for FM. Only if you have that, you will be able to build up on it based on the type of question that they, shoot at you. So if you don't have this foundation, what you will end up seeing is, you'll just read a question, you don't even know where to start. At one point, you will be wondering, okay, is this from investment appraisal? Is it from cost of capital? Your problem will be you don't even know where to think from. Okay. So definitely today, it's a good point to start. Don't even waste a day. Okay, after this, don't waste a day. You have already wasted. I'm sure if you haven't started, most of you must have thought, okay, February 1st, I will start. Okay, but now, believe it or not, 1 week has gone. And that's it. It's not going to come back. So if you haven't started right now, soon after this TRG, start. Okay, not even tomorrow. Tomorrow is too late. Okay, right. So how is this going to help you? Okay. So I assume at this point, all of you would have gone for some sort of lecture. You have some sort of a study text, some sort of notes, something to explain what FM is about, you have. Okay. So what this TRG is going to do, I'm not going to go again and start explaining theory. Okay. That will take me 6 months to do. Okay. So what I am going to do is I'm going to start picking questions. Okay. Where, I feel that, the examiner tends to ask questions a lot in that particular area. But at the same time, I will try my best to make sure that I cover all areas of the syllabus that are examined. I can't say it's 100%, maybe about 80 to 90%. Okay, so the areas that are most important, I will cover it through these questions. So I'm not going to go through the theory beforehand itself, but while I'm talking about these questions, I will, refer a few slides and explain it a bit. Okay, so these questions are all from the Kaplan revision kit. Okay, I hope all of you have it. If you don't have it, please drop a message on the group that we have, the WhatsApp group. I will share all these questions, the ones that we're doing. I will share it on the group. Okay, right. Yes, so that is just about what this TRG is going to look like. So every day we will be doing 3 questions. Okay, 3 constructed response questions. It won't be MCQs or MTQs, okay? Because if you can do the constructed response, then chances are that you will be able to manage the MCQ and MTQ as well, okay? So we won't be doing MCQs and MTQs. We will be doing the bigger questions. And while we're doing that, we will cover areas of the syllabus, okay? Another important aspect you have to understand about FM is, now let's look at this pot company. For example, this is the first question we're going to do. It starts in one area of the syllabus. For example, it's starting with investment appraisal. Then it's moving on to things like sources of finance. So you will see this in almost all questions. Okay. So if you're just learning investment appraisal, for example, you only know investment appraisal and you're trying to do the questions based on investment appraisal, then there is a very good chance that you won't be able to answer all parts of the question. Okay. So if this was January or December, that's not a problem. But now we are at February. So the best option for you, take my advice, the best option for you is learn everything that you need to learn, the theory, the calculations, the equations, whatever it may be. Learn it first and then come to the revision kit. Don't think you can learn one area, do the revision kit, and then learn another area, do the revision kit. It won't work. Okay, because then what will happen is you will end up doing half of each question. And then the important part of another chapter, you won't come back to because you will think I already did that. It's in investment appraisal. Okay, so if that is, what you're trying to do by, just doing one part of theory, then the questions, and then another theory, another question, don't do that. It's just a waste of your time. Okay, so learn the theory first. Whatever you have to know it. While you're doing questions, if you forget, go ahead, refer it, no problem. But finish the studying part first and then come to the questions. How long can you take to do this studying? From today onwards, you can take about 5 days just to get your theory straight. Okay, go through your notes, go through your slides, do whatever it takes for you to remember what you studied. 5 days, that's it. Then, with whatever you know, start the questions. As you do the questions, don't worry, your knowledge, it will start building up. The more questions you do, the more your knowledge will start building up. Okay, so like I said, it's just that foundation that you need to do in these 5 days. After that, the questions itself will help you. Okay, right. So before I start this question, let me talk about, the syllabus a little bit, and then I will start with this question. So as you all must be aware, this syllabus, okay, it's divided into a few areas. Okay. The first area is called financial management function, financial management environment. Now, these two areas are the shortest areas of the syllabus. 2 areas, you will see them question number, theory and calculations. Both are equally important. Okay, they can ask you theory in MCQs. They can ask you theory in constructed response. They can ask you theory, like basically as a, like 1 of 4 answers, or they can even make you write paragraphs on that particular area. Okay, so don't neglect theory for this paper. It's gonna be very difficult, it's going to be almost impossible to pass if you're not going to at least, know a little bit of theory. You can't pass this just based on calculations. I'm telling you, chances are very, very, very low. Okay. Then we have another area called working capital management. Okay, so what is this area talking about? In simple words, I'll put it to you. All of you know the balance sheet. All of you know the balance sheet. What do we have in a balance sheet? Non-current assets, equity and liability, non-current liabilities, current liabilities. Those are the headings. Okay. What is working capital management going to talk about? They are going to analyze the current assets area of the balance sheet. That's your inventory, your trade receivables, your trade, your cash, okay, assets and the current liabilities. Those 2 areas of your balance sheet, working management will try to look at that in detail. And why do we give such importance to working capital management, current assets and liabilities? Because a business can have any amount of profit in their income statement. You can have billions of dollars of profit, but if you don't have cash in hand, that is the first step for you to go bankrupt. If you can't pay your suppliers on time, that's a problem. If you can't pay the bank interest on time, that's a problem. You might have to close down. No matter how many billions of profit you have, if you don't have the cash in hand, that's a problem. Management. We have to manage our assets and liabilities properly. Then comes another very important area called investment appraisal. Okay, so what is this talking about? Basically, when you have cash, when there are projects that you can invest in, how am I going to decide where I'm going to put my cash? Like, for example, you might have project A, project B, project C, project D. Question is, where am I going to invest? Am I going to do B? Am I going to do C? Because I might not have enough cash to do everything. So what's the best option for me? I should go for the most profitable option. So in appraisal, they figure out, okay, what's the most profitable option we have? Okay. About in investment appraisal, there are a few important, or the net present value, very important. They can ask you even 10, 12 marks just based on that. There's another one called IRR, another one called payback. Okay, so these are the basically the 3 main investment appraisal techniques you have to know. Business finance, basically, if you want money, okay, so if you have the money to invest in the project, no problem. But suppose there is a project, it's profitable, but we don't have the money. So what do? We have to take it from somewhere. You have to either take a bank loan, we have to issue shares, or we have to go for some other option. Business finance talks about which option would be the best for us. So which one is cheaper? Which one is less riskier? Okay, so which option should we go for when we need cash? So that's what business finance talks about. Business valuations, on the other hand, suppose we want to value our company. We want to know as a whole, how much is our company worth? Okay, how much is my company worth as a whole? Then there are different methods that you can do to value your company. So one situation where you have to do this valuation is, suppose you want to sell off the company to somebody. Then you have to know, first of all, what's a good price to accept. Okay, I have to know how much is my company worth. Only then when somebody comes and gives me a proposal, say $500 million, they're saying, are you willing to sell? I have to know whether that's a good option or not. So for that, I should first know what the value of my company. That's what we do in business valuation. Risk management, okay, that's basically the area. This is where we try to reduce risk. Now, I'm going to say something. Just remember this. because it's a very important, it's a very important concept when it comes to FM. If you are running a business, okay, this is a financial management perspective, okay? If you are running a business, making a profit or making a loss is not an issue, never an issue, okay? Because any businessman would tell you, business means one day there will be profit, one day there will be loss, okay? You can't expect every day to have a profit. No, that's not business, okay? That is, so making a loss is not a risk for the business, okay? It's not a risk because it happens. Everybody knows it will happen. Then what is risk? Okay, what do we call risk in financial management? It is the fact that you're not able to predict when to make a loss, or you're not able to predict that you're going to make a profit. Now today in February the 6th, okay, if I can't predict and say in December 2024, I'm going to make a loss, let's say that's a prediction. If I can't do anything today to help me in December. So risk is where we are not able to forecast properly, or whatever we forecast, it changes. There is a variation in the forecast. That is risky. Because if we can predict that there is going to be a loss, then we can do something about it today. Okay, so risk in financial management is never about the fact that you're going to make a loss. That's never a risk. The risk is the variability of your returns. We predicted something that didn't happen. That is risk. Okay, so these are the core areas of the FM syllabus. Employability and technology skills you must be knowing. It's there in all the skills level papers. They're just teaching you how to use the spreadsheet and word processor, which I'm sure you must be good at. Even if you're not, don't worry. While we're doing questions, I will show you how to do it in your spreadsheet as well. Okay, right. So keeping all that aside, let's start off with the first question. Don't worry, I will start from the very beginning. Okay, so I won't just, start straight away. I will talk a little bit about the background and then only I will do the question. So let's read this. This is Spot Company. It's from December 2013. They have changed the question a little bit in the Kaplan revision kit. Okay, so it says here, Spot Company is considering how to finance the acquisition of a machine costing 750,000 with an operating life of 5 years. There are two financing options. Okay. The first option is the machine could be leased for an annual lease payment of 155,000 per year, payable at the start of each year. Okay, so there is one option that we have, and that is to go for a lease. So what are we talking about here? Now we want to buy a machine. Okay, for some reason, for our business, we want to buy a machine. That any business will have that requirement. Okay. The question is, now this machine is costing me 750,000. Okay, it's costing me 750,000. The question that I have to answer is, am I going to buy the machine outright? Okay, giving the 750,000, or am I going to go for a lease option? Okay, so what is a lease? A lease is where you don't have to pay the entire 750,000 at one stretch. You can pay it basically like in installments. Okay, so there are two types of leases. One is a long-term lease and another is a short-term lease. Okay, there are differences between the two. I will talk about that in a bit. So that's what they're saying. Option 1 is to go for a lease. The option 2 is saying the machine could be bought for 750,000 using a bank loan charging interest at an annual rate of 7% per year. At the end of 5 years, the machine would have a scrap value of 10% of the purchase price. If the machine is bought, maintenance cost of 20,000 per year will be incurred. Okay, so option 2 is for you to take a bank loan of 750,000 and buy the machine, and obviously you will have to deal with the bank and pay interest, and all those things are obviously going to be there. Okay, so let's talk about the two different types of leases a bit. Right. 1 second. Okay. Just give me a minute. Okay. So the first type of lease you have to know about is called a long-term lease. Okay, it's called a long-term lease. Okay. So what is this lease? It's basically where the person who owns the asset. So lease means, now if this is the machine, there is a owner. He's called the lessor. Okay. And now this company, which is Spot, they are the person who is renting it from them, and they are called the lessee. Okay. So a long-term lease, how it works is basically, all you have to know, I'm just giving you, just the cream of the entire scenario. The risk and the reward. Okay. So risk and reward means basically everything to do with the machine. All the maintenance. Okay. If you sell it, then the amount that you get from the sale, everything is transferred from the lessor to the lessee. Okay, so in other words, after the period of the lease, the lessee becomes almost like the owner of the asset itself. That's a long-term lease. Okay, so the important thing that you have to understand is in a long-term lease, the risk and rewards are transferred from the owner, the lessor to the lessee. Okay, then there's another type of lease called a short-term lease. So here what happens, the risk and rewards, it is not transferred. It remains with the lessor. So any maintenance, big maintenance, the lessor only has to provide. They are the ones who have to undertake that cost. At the same time, if they sell the machine and they get some proceeds, then the proceeds the lessor can keep. Okay, so these are the two types of leases. Again, you don't have to know great detail like how in FR. You just have to know what these two are, that there are two types of leases. In one, the risk and rewards are transferred. In the other, it's not. Okay. Now, that is not what we are concerned about with FM. Okay, what are we concerned about? For a machine, we can either go for the leasing option. Okay, one second. We can either go for the leasing option or the buying option. So how do we decide? Are we going for the lease? Are we going for buy? The decision is very simple. We go for whichever one is cheaper. Okay. Right. Now, we are going to talk about a very important area. When it comes to financial management, okay, when it comes to financial management, if a particular amount of cash, you're going to receive it, let's say in 1 year's time or in 2 years' time. So I'll just write this down. Let's say year naught, that's today, I'm receiving $500,000. It's not the question. I'm just explaining another point. Year 1, I'm receiving say 450,000, and year 2, I'm receiving 800,000. Okay. Now you have to understand this. It's a very important concept in financial management. The 500,000 that you receive today, okay, and the 450,000 that you receive in 1 year's time, it's not the same. Okay, because 500,000 that you receive today, fine, you got the cash in hand, you can do whatever you want with that. Okay, but the 450,000 that you're receiving in 1 year's time, or the 800,000 that you're receiving in 2 years' time, you can't say that it is actually worth 450 itself. Okay, because 450,000, if you receive it today, it will be more valuable than receiving it in 1 year's time. Think about it. If I got the 450 today itself, if I got it in year naught itself, at the very least, I can at least put it in a fixed deposit and earn interest, right? In year 1, it will be much more than 450,000. So an amount that you're receiving or paying in a future date, it is not the same as receiving that same amount presently. Okay. So that concept, we call it the time value of money. Time value of money. It's very simple. What we are saying is, if you receive something in year 1, year 2, it is not the same as receiving that same amount today, because if I get it today, I can do much more with it. Okay. So if you're going to take a decision, for cash flows that you're going to get on future dates, first thing that you have to do is you have to do something called discounting. You have to do something called discounting. So what is discounting? We are trying to calculate how much is 450,000 worth in today's terms. Okay, in 1 year's time, it's worth 450,000. But if I got it today, then how much is it worth? In 2 years' time, I'm getting 800,000. But if I got it today, how much is it worth? So what we are doing by discounting is we get what we call present values. Okay. And then once we get all the present values, let's say we get the present value of 450 and the present value of 8,000, then we can see 500 plus this, how much is the net present value. If it is a positive figure, then we can say, fine, this investment, it is actually a good investment. Okay. So what is important is that if you have a cash flow happening at a later date, first thing is you have to bring it back to present value. So how do we do the present values? You must be knowing it. You have to multiply it with something called the discount factor. Okay, so discount factors, these are available at your exam. You have an entire table from 1% to 20%. You can multiply the future value with the discount factor and get the present values. Okay, so this is the bare basics that you should be knowing at this point. Okay, right. So now let's look at this pot company, a lease versus buy decision. So A part, lease versus buy. First, what you need to do is get the present value of the lease payment. Okay, so let me see what they're saying about the lease payment. They're saying you can lease it for annual payment of 150,000 per year, payable at the start of each year. Okay. And for how many years is this happening? For 5 years. They're saying the machine is costing 750,000 with an operating life of 5 years. So year naught, which is today, year 1, year 2, year 3, year 4. Okay, year 5 also, I'll just write it. So what is happening? Every year we have a payment of 155,000. So it's at the beginning of the year, right? Usually it will start from year 1 if it is paid at the end of the year. But in this question, they're saying it's payable at the start of the year. So at the start of year 1 is the same as the end of year naught. So that's why I have put it as 155,000. So year 1, you will have to pay 155, year 2, year 3, and year 4. Okay, last payment will happen in year 4 because operating life is 5 years. So 1, 2, 3, 4, 5. Okay, so we have paid for 5 years. Right. Now, when we have a figure like this, okay, where the monetary value is fixed every year, it's 155,000, and the number of years also is known. We know that it's happening for 4 years. Okay, I mean until year 4, a total of 5 years. Then we call this kind of a cash flow, we call it an annuity. Okay, and how do we discount an annuity? Basically, you take the figure which is 155,000, multiply it with the annuity factor. Okay, you have to multiply it with the annuity factor. So if you look at here, they should give us a percentage for interest. Let's see, the machine could be bought using a bank loan and interest is 7%. So you can take the annuity factor at 7%, but watch this. Usually, when we have annuities, okay, I'm just talking about the usual scenario. I'll draw a timeline. Year naught, year 1, year 2, year 3, year 4, year 5. Usually when you have an annuity, guys, it starts in year 1. Okay, usually this is how it goes. So when that is the case, when it usually starts in year 1, then we don't have a problem. We can take the 155,000, multiply it with the annuity factor. But in this case, there is a payment that is happening in year naught as well. So we have to consider that as well. So for the time being, let's take 155,000 into the annuity factor at 7%. For how many years? It should be for 1, 2, 3, 4 years. Okay, so we are just looking at these 4 figures. So for 4 years, let's get the present value. So let me go to the table really quickly. Give me a second. This will also have it. 4 years, it should be 0.387. Okay, 3.387. So 155,000, you have to multiply it by 3.387. So let's see how much that is. $155 into 3.387, which is 524,985. Okay. Now I have got the present value for what are the numbers? I have got it for this, and this. I have brought it to year naught terms. Okay, I have brought it to year naught terms. But in year naught, there was another payment also that happened. So I have to add that. You can't forget that. 155,000. So that will be 679,985. Okay, so this is the present value of the lease payment. So if I have to pay the lease, if I'm going to go for the lease option, then it would cost me in total, it will cost me $679,985. Okay. Now the next question is, I have to compare this with the buying option. Okay. So this is the present value of lease payments. Yes, I'll give you a minute. You can take this down. And then let's compare this 679,985. Let's compare it with the buying option. Whichever one is cheaper, we will go for that. By the way, guys, if you all have any questions, you can. Okay, so I hope you've taken this down. Let's do the buying option. Okay, so buying option 2. Right, so the buying option, let me write the years. We have year naught, which is today. And then we have year 1 to 5, and then we have the 5th year. And let's think about the cash flows. So they're saying we can buy it for 750,000 today. So the purchase will be 750,000. Okay. Then at the end of 5 years, the machine will have a scrap value of 10% of the purchase price. So 10% of 750,000 is going to be 75,000 scrap. 75,000 is positive. This is negative. Then year 1 to 5, what happens? If the machine is bought, a maintenance cost of 20,000 per year, you will incur it. So from year 1 to 5, you will have to pay a maintenance cost of 20,000. Okay. So these are the cash flows that you will have to incur if you buy that particular machine. So these are also not all in present value terms. They are happening in year 1, 2, 3, 4, 5. Okay, so first thing is I have to convert them to present value. So let me get the discount factor at 7%. Year naught will always be 1. Then year 1 to 5. So 5 years annuity factor, right? Because it's 5 years, 7% annuity factor will be 4.1. Okay, that will be 4.1. And then the 5 years discount factor, which we have to look here in the other table, 0.713. Okay, 0.713. So now I can get the present value at 7%. So 750,000 into 1 will obviously be just 750,000. 20,000 into 4.1 will be 82,000. And 75,000 into 0.713 will be 53,475. You can take a total. The NPV, we are calculating the NPV, net present value, which is 778,525. So if we buy the asset, we will incur a cost of 778,525. If you lease the asset, you will incur a cost of 679,985. Now, how do you choose? Are we going to lease or are we going to buy? Basically, you will go for the cheaper option. So, the cheap option is obviously to lease. Okay. So, finally, at your exam also, make it a point to write the conclusion. So, what you will have to say is, as a conclusion, leasing, I'll write it since it's too small. Leasing is cheaper since the present value of leasing of the leasing option is less than the buying option. By, you can put the difference also between the two numbers, 778,525 minus 679,985, that is 98,540. Okay. So if you do this, you get 10 marks. So it's a very straightforward question. If you knew how to do lease versus buy decisions, it would be easy. Even now, for example, this is also an NPV calculation. But if you didn't know that you have to do NPV to check the buying, the present value of buying, then you would just unnecessarily lose a lot of marks there. Okay. And leasing also, again, it will usually be an annuity. So you will have to multiply with the annuity factor. In this question, what is new is there was one lease payment in year naught. So why did that happen? Because they said we are paying at the beginning of the year. Okay, because they said this only, there was 155K in year naught. So that is the only change in this question when it comes to the lease. So you can't ignore that. You will add it to the present value of the other lease payment. Okay, is that clear? Are all of you okay? Any questions? Okay, so now see, this entire question is 20 marks, but they are talking about calculations only for 10 marks. Okay, the remaining 5 and 5 is going to be entirely theory based. So you have to be okay with writing theory as well. Okay, so let's look at the B part. It says, discuss the attractions of leasing as a source of both short-term and long-term finance. So the question is asking you, why is leasing better than buying? Why is leasing better than buying? And we have 5 marks. So you have to basically make 5 points. Okay. So let me just think about it. Okay, let me show you how to think. Leasing is like renting. Most of the time, leasing is like renting. So just think, what are the advantages when it comes to leasing? And in this case, it's a machine, right? The first thing that comes to my mind is, if you are leasing, especially if it's a short-term lease, okay, you have the option of cancelling a lease quickly, sending back that asset to the lessor itself and going in for another machine. So let's say, for example, one machine is becoming a little outdated. Okay, it's becoming a little outdated. You don't have to worry about it. You can just cancel the lease and go for a more up-to-date machine. Whereas if you buy the machine, then you can't do that. You have to sell the machine. You might incur a loss and then you have to buy another machine. Okay, so it's not very straightforward. Whereas leasing, you can easily change the machine. So you will never have a problem of the machine becoming obsolete or becoming outdated. So that is one advantage of leasing. Okay. The other advantage is, now this cancelling, especially if it's a short-term lease, you won't have a penalty or anything as such. If it's a long-term lease, yes, there is a problem. But if it's short-term, you won't have penalty. So it's easy to cancel and enter into another agreement. Okay, so that is another advantage. The other thing about leasing, I told you, if it's a short-term lease, the risk and rewards is with the lessor. So he has to be responsible for maintenance. Okay, he has to be responsible for maintenance. Now, let's say, for example, these are sewing machines. Okay, if the lessor, let's say he has about 1,000 sewing machines that he's sending on rent. Okay, he's sending it on rent. So, for maintenance, the lessor will probably have a good team who will be really good at maintaining all these machines. So, if you're going for leasing, then you might have access to skilled maintenance teams, because the lessor, his business is itself leasing this type of machine. Whereas if you go for a long-term lease or for a buying option, then what will happen is you have to decide on how you're going to do your maintenance. Okay, you have to decide your maintenance. So you might not have that kind of skilled maintenance if it is a long-term lease or a buying option. So another reason why short-term is good. So already I have made 3. One is, you won't go, your machines won't get outdated. You can easily cancel it. And the third one is, you will have good maintenance because the lessor is taking responsibility of that. Okay. Now let's talk about long term. Okay. So why is that good? So the thing about long term, when you compare it to buying, is, now it costs us 750,000. No. If you go for a long term lease, obviously you don't have to pay this 750 immediately. You can pay it in installments. Okay. So if you have to pay something in installments, that is always good for the cash flow of the business. Okay, it's easier. You can pay in smaller quantities, so it won't be much of a burden for your business. So that is an advantage of a long-term lease. Okay, and both long-term and short-term, they give you access to the assets. Okay, whatever the asset may be, it will give you access to it. A lease will give you access to it where you don't have the option of going for a bank loan. So sometimes some companies, the bank will refuse to give them a loan. So in that situation, they don't have to not wait without the machine. They can, enter into a lease and at least get their hands on that particular machine. Okay. So if you made the 3 points about short term, if you made that 1 point about long term being easier to pay than paying at a stretch, and finally saying that short term and long term both are better than buying because, if you don't have access to finance, it's good, you have your 5 marks. Okay, so always the number of points that you're going to write, it will be determined by the number of marks you have. So if there are 5, make 5 points. Okay, you might hear people saying, if it's 5, make 3 points, it's enough. Okay, it's not always true. If you make 3 points and want to get 5 marks, you have to make 3 very good points. Okay, which you don't know whether it's going to be good or not. You really don't know. So the better option is, even if you're going to make mediocre points, make 5. So even if it's a small point, they have to give you the mark. Okay, because for 1 point that you're making, the examiner giving you 2 marks is very rare unless it's a really good point that you're putting forward. Okay, so 5 marks, always have 5 points. Okay, right. So that's what you will have to say in the B part. So C, it says, in Islamic finance, explain briefly the concept of riba or interest and how returns are made by Islamic financial instruments. So here the question is divided into 2. First part is saying, explain the concept of riba. And the next part is saying, explain how Islamic financial instruments make returns. So let's answer the first part. What is the concept of riba? So when it's riba or interest, basically the person who gives the cash or the source, the person who is the source of finance, he is promised a particular amount, a predetermined amount of return. Okay. So for example, if I go and pay the bank or, I deposit $500,000, they will tell me for sure 10% of that, which is 5,000, right? 500,000. Yeah. No, sorry. If I deposit 500,000, for example, okay, and the return rate is 10%, then for sure they will tell me $50,000 every year we will give you as interest. Okay. So that is riba. Okay. Where the person who is depositing the money, the person who is lending the money, he is given the promise of a return, and the amount that he gets is predetermined. It will never change. This 50,000, it will never change because it is a percentage based on how much he deposited. Okay. So that's the first point you have to make. The next point you have to make is that riba is completely not permissible when it comes to Islamic finance. Okay. So if you make those 2 points, you have answered the first part of the question. Now the next part is saying how returns are made by Islamic financial instruments. So let me quickly go to that slide. If not, it will take time. So there are 5 Islamic instruments that we talk about in this syllabus. Okay, so let me go to that really quickly. Even if you mention the 5 and give a small explanation of each of them, that's more than enough. Okay. Yeah. So let's just quickly go through this. So the 5 that I spoke about, one is murabaha, the other one is ijara, third is sukuk, mudaraba, and musharaka. Okay. So you do now, it's only 5 marks. No, already 1 mark you will get for explaining what is riba. So another 4 marks you need. So you don't have to explain all 5 of them. You can maybe just mention all 5 and maybe explain 2 or 3 of them. Okay. So the first one you can probably mention is murabaha, or it's trade credit, or it's a loan. Okay. So how this works is, the person who has the cash, he doesn't directly give it to the person who needs the money. Okay. What happens is, now for example, if you want to buy a car, okay, let's say I want to buy a car, I don't go to the bank and ask for a loan. What happens is, the bank, they buy the car on their behalf. Okay, they buy the car on their behalf and they basically sell the car to me. Okay, so let me just draw it. We have the bank. Okay, so there is me. I want the car. Then there is the bank. And this is the car that I want. Okay. So instead of going to the bank and asking them for a loan, using that money and buying the car under my name, what happens when it comes to Islamic finances? The bank buys the car first. Okay. Let's say they bought it for $10,000. Just saying. Then what they do is, they sell me the car. They sell it to me. And according to Islamic finance, you can sell at a higher rate than what you bought, because that is not considered interest, that is considered profit. So what they do is, they can sell it to me maybe for $11,000. Okay, so they can sell it to me for $11,000. But still that doesn't solve my problem. No, my problem is I need money to buy the car. I don't have it. Now instead of 10,000, I have to pay 11,000. Okay. So what happens in Murabaha is, they sell it at a higher price, but they give you the option of paying in installments. So there my problem is solved. 11,000, you don't have to pay maybe right now. You pay it over a period of 5 years. So 11,000 divided by 5, that amount you will have to pay the bank. That is how Murabaha works. You have to explain that. If you do that, you can easily get 2 marks. Okay. Then another type of Islamic finance is called ijara, or a lease. Okay. So this is similar to lease finance, where the bank, they own the asset. Let's say a machine, they own it. They allow the customer to use it for a particular period of time, like a rent. Okay. So not only should the bank give you access to the asset, they should also tell you what exactly you can do with the asset. Okay, they have to tell you that clearly. That is an important aspect. And finally, the lessor or the bank is responsible for major maintenance, and lessee is responsible for maintaining the asset in good shape. So, for example, if you have a machine and that requires a big maintenance, that the bank has to pay. But small things like, oiling the machine and all, that the lessee has to take responsibility. That's Ijarta. Okay. Then we have sukuk or debt finance. Okay. So here this is, it's not really like debt finance, right? Because whenever we're talking about debt, the first thing that pops into our mind is interest. But again, interest is not allowed. So although we call sukuk debt finance, it's not really debt. Okay. So see how it works. Islamic bonds are linked to an underlying asset such that the sukuk holder is a partial owner in the asset and profit is linked to the performance of the asset. Okay. So for example, if somebody is giving me a loan, I'm a business, somebody is giving me a loan, it can't just be like a bank loan where I keep him as a third party. When it comes to sukuk, whether I like it or not, the person who gives me the money, he will also have the right to, have a say in the running of the business. He essentially becomes the owner of the business. Okay. So when it comes to normal debt finance, the bank, especially when we are taking a bank loan, we don't give them shares. We don't give them ownership. Okay. We pay them an interest, but they're always third party. Bank can't come and tell us what to do. But when it comes to Islamic finance, the moment you take cash from somebody, that person also has the right to, claim ownership of that particular business. They have a right to say what to do in the business. Okay. So that is sukuk. So whatever you give them, usually bank means you have to pay interest. Here, the sukuk holder, you have to basically give him a portion of your profit. So if the business does well, he will get a bigger portion of profit. If it doesn't, then he gets a smaller portion. Okay. Then we have mudaraba or equity finance. So here it's like equity, meaning the person who is giving the money, he is the only, like it may be like a partnership. Maybe there are two people. Okay. So let's say the person giving the money is the bank. He will give the money and he won't really take part in the running of the business. Okay. Who runs the business? It's the person who takes the money. Okay. So let's say this is the bank. Bank gives the money to a person. Let's say his name is A. Okay. He gives the money and the bank will not get involved in any of the running of the business. The running is completely done by A. That is mudaraba. In sukuk, even the bank starts, talking about the business and giving a say. But here, the bank doesn't, get involved in any of that. Only the, only person A will get involved in the running of the business. Okay. But whatever profit you make, there will be a pre-agreed ratio. So maybe the bank will say, we have to share profit 60-40. So A gets 40%, bank gets 60%. So if there is a profit, then the bank will get 60% of the profit, A will get 40%. Okay. But if there is a loss, then the bank has to bear 100% of the loss. A doesn't have to bear it. Okay. Because A was in this business only because he had expertise. He didn't have money. So it's not fair to go and make him bear the loss. Okay. So the bank has to bear 100% of the loss. Whereas when it comes to the profit ratio, it can be shared according to a predetermined ratio. Finally, musharaka. Okay. So this is where again we have two parties. Okay. Who will contribute? So A, now in this case, the bank also will give money. A is also giving money. Both have cash, so both are giving money. So when it comes to profit also, we can divide it according to maybe whatever ratio, 60-40. Okay. But when it comes to losses, then if say the bank gave 50% of the cash for the business and A also gave 50% cash, then based on the proportion of how much money they put in, they have to bear the loss. So 50% of the loss bank should bear, 50% of the loss A should bear. Okay, so what happens in musharaka basically? For example, if the bank gave 80%, of the finance, A put 20%, then losses also has to be shared in that same ratio. bank has to take 80% of the loss, A will have to take 20% of the loss. So you can see there is a lot of points over here. You don't have to write all of this. Okay, even if you mention their names, that itself will give you a few marks. But if you can slightly explain a little bit, 1 or 2 points, that's more than enough for the 5 marks. Maximum you can go up to 8 marks when it comes to Islamic financial instruments. Okay, so that's why I took some time to explain that. So I have given you the explanation. You have to figure out how, I mean, there's nothing to figure out here. You have to know how to write it in 1 or 2 points. Okay, so if you make those statements, you can easily get 5 marks. So 5 marks, actually, you can even write for more than 5 if you see Islamic finance. But don't write. If you have 8 marks, write for more than 5. If it's 5, just make 5 points and call it a day. Okay. Right. So that's all about spot company. Any questions so far? Has it been clear? Okay, so there are a lot of people who have joined and left, and a lot has happened here. I'm just having a look at it right now. So those of you who are in the call, is it clear so far? Do you have any questions? Okay, so I'll take the silence as there is no question. And since it's 7:03, we started at 6. Okay, so in case any of you have to take a prayer break, uh, you can go now and be back at 7:15. Okay, so take a 10 minutes break and come back. We will do 2 more questions, hopefully. We will do 2 more questions. One will be to do with risk management, money market hedging, those things. So we will start off with that and we will end with a question based on NPV. Okay, so if you have problems with financial risk management, then please make sure to join in. So I'll see you in 10 minutes. Be back at 7:15. Okay. Sorry. Okay. Yeah, so I was saying I hope all of you guys are back. The next question we'll be doing is a question called NEDWEN. Okay, so in this question, we focus on foreign currency risk. Yeah, is it okay now, Ifas? Yeah, I think it should be okay. If you can hear me. Okay, thanks, Yunus. Okay, so now we are going to look at a type of risk called foreign currency risk. There are only two types of risks you have to know in this paper. One is forex or foreign currency risk. The other one is interest rate risk. Okay. So in simple terms, what is this risk? So I told you in financial management, the risk is always variability of return. So when it comes to foreign currency, the main risk is where, say, you predict. Now, let's say we are in the UK, our base currency is pound, okay, and we are going to get dollars, say $300,000. So let's say today in February, we predicted that $300,000 when we convert it to pounds, we will get about, say, 270,000 pounds today before we get it. But on the day that we actually get those dollars, the exchange rate has moved and the amount that we receive is 260,000 pounds. So can you see that there is a risk? What is the risk? You predicted that you will have 270,000 pounds in hand, but when that transaction actually happened, the amount that you got is 260,000. Okay, so that is, that is the example, or basically a situation where the return that you got is different to what you predicted. So there is a variability of return. Okay, so that is the main type of risk that you have when it comes to foreign currency. So when it comes to it, we talk about transaction risk. So that is exactly what I explained now. Okay, with the risk of the exchange rate changing between the date of transaction and the subsequent settlement date. So the date of transaction is maybe today, when we actually maybe sold the goods and we wrote down in our books, we have to get $300,000 in 3 months' time. That will be 270,000 pounds. So that's today. But the date they settle, which may be 3 months later, they will give you 300,000 pounds because maybe they are based in the US. But when you convert it to pounds, you end up only getting 260,000 pounds. So that is a risk. Okay, that is transaction risk. The second type of risk that we talk about is called economic risk. Okay, so this is basically a long-term version of transaction risk. So this happens especially when you are in the import-export business. Okay, so if you are always, dealing with foreign companies, then what happens is you are always at risk of that exchange rate moving and you making a profit or loss. Okay, so economic risk is the same as transaction risk, where the amount that you get and the amount that you predict is different because of the change in exchange rate, but it is a long term version of transaction risk. If you have to explain it, you can explain it like that. The last type is called translation risk, and this is a situation where you have a parent in a parent company in one country and a subsidiary company in another country. So when the parent consolidates the financial statements, obviously they will convert the subsidiary's information or the subsidiary's monetary values into the home currency of the parent. So let's say, for example, we have a parent in the UK and they have a subsidiary in Sri Lanka. Okay. Now the accounts in Sri Lanka, it will be in rupees, whereas the parent's statements will all be in pounds. So when the consolidation happens, this UK parent, they have to convert all the rupee figures into pound figures. So when that conversion happens, there is a chance that there will be profit or losses based on the exchange rate. Okay. So that risk is called a translation risk. These three, it's a very common question to ask you to explain each of them. So they can maybe ask you that question for about 5 marks. If you mention the 3, that will be 1 mark, and explanation of 3 will give you the remaining 4. Okay. Right. So what the other thing that you have to know is when you have a foreign currency code. So for example, let's say today in Sri Lanka, if you ask the US dollar, how much is it for a rupee, they might tell you something like this: 317, 324. Okay, so they're saying 1 rupee is equal to 317 or 324. So you're not sure, is it 317, is it 324? Okay, what it means is 1 is the buying rate. Okay, so what is buying rate? Basically, the rate at which, now if you have dollars in your hand, if you go and sell it to the bank, how much will they buy for? The other is the selling rate. So selling rate means if you are going to the bank and buying the dollars from them, how much will they sell for? So always remember, the bank always will sell low. The bank always sells low and buys high. Okay, so you can remember it as the bank buys high and the bank sells low. Okay, right. So that's what they speak about here. The other important, we speak about things like purchasing power parity theory, interest rate parity theory. We'll come to that with another question. What I want to talk about here, most importantly, is how to hedge a risk or how to reduce this risk. Okay, so there are three main methods. One is a forward exchange contract. So what's a forward? Basically, now today, we know that in 3 months' time, we will get $300,000 now. So what we do is today itself we go to the bank and say, in 3 months I will bring $300,000. How much can we agree to convert it for? Okay, so maybe they will say, okay, this is the rate. In 3 months, when you bring the 300,000, we will convert it for you. So then you can see today itself I can decide in 3 months how many pounds I will have in hand because the bank has agreed on a rate. So there my risk is completely gone. Risk means I can't forecast. But if the bank is telling me, yes, in 3 months we will convert at this rate, then I have a forecast. That is a forward exchange contract. Okay. So one way to hedge a risk or reduce a risk is to go for a forward exchange contract. Another way you can hedge a risk is using something called a money market hedge. Okay, so this is entirely calculation based. You just have to know how to do the calculation. Okay, so we will do this question. It has a money market hedge calculation. Another thing you can do is you can go for something called a currency future. Okay, so I will explain that also in this question. Or let me just talk about it quickly. Currency future, how it works is like this. Now we have a particular transaction. Okay, what is the transaction? In 3 months' time, we are going to sell $300,000. That is a transaction. Now our problem is what? We, like for example, today, if I convert this 300,000, it's going to give me 270,000 pounds. Okay. Now my worry is that when I convert it 3 months later, I get 260 or I get 280. Even although 80 is more than 270, that is also risk because risk means I'm not getting 270 exactly. Okay. So what happens with the future is you don't do anything about this 300,000 that you're going to get. What you do is today you either buy or sell futures. Okay, you don't have to know the exact details. Okay, you see over here itself it says very clearly calculations are not required for FM. That's something that completely falls under the AFM syllabus. Okay, but I'm just saying you either buy or sell futures today. Okay, and what will happen is, let's say you're making a loss in 3 months' time. Okay, you only got 260. You were supposed to get 270. You only get 260. Then the futures contract, you will make a profit. Okay, so what I'm trying to say is, if the actual transaction you made a loss, then the futures transaction you will make a profit. Or in the actual transaction you made a profit, like here you made 280, then the futures transaction you will make a loss. So what happens is a loss or profit, whatever it is, it will cancel each other off. So ultimately, there is no variability of return. So if you predict 270, it will remain at 270. Even if you get more, then that extra 10,000 anyways, you would have lost in the futures deal. If you get less, 260, then you would have made an extra 10,000 in the futures deal. That is what a future is about. Okay. The other option that you can go for is called the currency option. So what is this? This is also like a forward, meaning we agree on a rate today. Agree on a rate today. But what's different in a currency option is, now let's say, for example, the actual, the exchange rate. Okay, so we have agreed on a rate and there is an actual rate that is actually happening in the market on that particular day in 3 months' time. Now, if you're going to get more pounds by converting at the market rate than the forward rate, then if you have an option, then you can forget about this option and go ahead and convert at the market rate itself. Okay, if that is going to give you a profit. So, for example, let's say if according to my option, when I convert, I will only get 270,000 pounds. But if I forget about this option with the bank that I came, I went to the bank and I asked them, give me an option. They told me, okay, on this day, 300,000 pounds, when you give it to us, we will give you 270,000 pounds. Like a forward, but an option means you can take this offer or you can leave the offer. So what will happen is, now let's say in the market, when we convert it, we are going to get 280,000 pounds. Then instead of going and trying to make the option work, we can make the option lapse and just go and convert our 300,000 pounds in the market itself. That is an option. But what's important is, because we have this flexibility, we have the flexibility of taking it or leaving it. A forward is not like that. If you enter into a forward rate agreement with the bank, you have to honor that agreement. Here we have the option, right? So that flexibility, it comes at a price. Meaning you have to pay like a premium. Whether you take the option or not, you have to maybe pay a premium of, let's say, 10,000 pounds beforehand itself. Okay. So that is a currency option. Finally, there can be two types of options. One is a put option, another is a call option. Put means it's the right to sell the currency, and call means it's the right to buy a currency. But then again, remember, it's a right, not an obligation. If you want, you can sell. If you want, you can buy. If you don't want, you can forget about the option. Okay. Right. So that's all you have to know with regard, the very basics that you have to know with regard to foreign exchange risk. So I hope that will be enough for you to do this question. Right. So let's read it. Nedwen Company is a UK-based company that has the following expected transactions. Okay. In 1 month's time, they have a receipt of $240,000. So they are UK-based, no? Their currency is the pound. So we are going to get in 1 month $240,000. Again, in 1 month, we have a payment of $140,000. In 3 months, we have expected receipts again of $300,000. So these are the transactions. The finance manager has collected the following information. Spot rate, dollar per pound. So what is spot rate? Today, if I were to convert dollars into pounds or pounds into dollars, I will have to convert at this rate. 1.7820 plus or minus 0.0002. So remember, bank buys high, sells low. Okay. 1 month forward rate is given. 3 months forward rate is also given. Money market rates for Nedwen Company. So this is for using in the money market hedging. 1 year sterling interest rate, they're giving me borrowing and deposit. 1 year dollar interest rate, borrowing deposit. Let's not worry about it. Assume that it is now April 1st. Okay. A part, discuss the differences between transaction risk, translation risk, and economic risk. Okay, 6 marks just for that. Okay, so that's what I explained right at the beginning. The 3 types of risk. Transaction is where there is a change in the exchange rate between the day of the transaction and the settlement date. Translation is when a parent is consolidating the subsidiary accounts, and because of the consolidation and conversion of currencies, there is a profit or loss. Economic risk, like I said, it's a longer term version of transaction risk, usually faced by businesses who are in the import-export business. Okay, so if you can discuss those, 2 marks for each. Transaction 2 marks, translation 2 marks, economics 2 marks. You should get the 6 marks. Okay, so let me just show you. I'll just read out what the marking scheme is saying. So about transaction, it's saying this is the risk arising on short-term foreign currency transactions that the actual income or cost may be different from the income or cost expected when the transaction was agreed. Okay, so you don't have to use their exact words. If you can say something along these lines, it should be okay. About translation, it says it arises on consolidation of financial statements prior to reporting financial results, and for this reason, it's also known as accounting exposure. Translation risk does not involve cash flows and so does not directly affect shareholder wealth. Okay, you can say that as well. And about economic risk, they say transaction risk is a short-term version of economic risk, which could be defined as the risk of the present value of a company's expected future cash flows being affected by exchange rate movements over time. Now, one thing I have to make a point here. You will see as you do a lot of questions. Okay, as you do a lot of questions, you will see certain questions repeating over and over again. Okay, you will see certain theory questions, right? I'm not talking about the calculations, theory based questions. You will see them repeating over and over again. So, in a situation like that, where you see there is a question they are asking over and over again, look at the answer and kind of have a mental note of what it's saying. Now, for example, this A part is an example of such a question. So take a mental note of what the marking scheme says, and if at all you see this question in your exam, instead of trying to think out of your head and writing, if you write what the examiner says or something close to what he says, then the chances of him giving you the mark is much higher, because obviously he's the one who wrote the answer, right? So this is what he's expecting to see. So if he sees that, obviously he will give you the mark quickly. If you have time, again, okay, if you don't have the time to do this, it's fine. You can just think and write the answer. That's not a problem. But I'm saying one of the smarter ways of tackling theory-based questions is that, where there are questions that repeat again and again, you already have the answer in your head. So you just have to go and write it down and, change it a little bit according to the information in that question. Okay? Right. So let's do the B part. Calculate the expected sterling receipts in 1 month and in 3 months using the forward market. Okay, so we are not talking about the money market. We are talking about the forward market. Right. So if you talk about 1 month, okay, we are going to receive 240. We are going to pay 140. So first of all, we can net it off. Okay, so let's talk about 1 month. We are going to receive 240, and from that itself we can pay 140. So the net receipt will be 100,000. Net receipt. Now this 100,000 only you have to hedge using the forward. Okay, so don't hedge the 240 separately and the 140 separately. It doesn't make sense now. When you get 240, pay whoever you have to pay 140, and the net amount 100,000 you can hedge. Okay, right. So when you get these dollars, when are you going to get it? In 1 month's time? We don't want the dollars, right? We are a UK based company. So what will we do? We will sell these dollars to the bank. We are going to sell the dollars to the bank. So then what is the bank doing? The bank is going to buy dollars from us. Always remember, the bank buys high. Bank buys at the higher rate. Okay. So if you look at the 1 month forward rate, it's 1.7829 plus or minus 0.0003. Bank always buys high, right? So we have to choose the higher rate. So that's 1.7829 plus 0.0003. So the rate that we're talking about is 1.7832. Okay. Right. So what we're trying to say is, for £1, you're going to get $1.7832. So this is the dollar per pound. It's given here, dollars per pound. Remember, if you have this, you have to first of all decide, is the dollar stronger or is the pound stronger? Okay, with 1 pound, you're getting more dollars. Okay, so that means 1 pound is stronger than the dollar. Okay, pound is the stronger currency because when you give 1 pound, you're getting more than 1 pound worth of dollars. So pound is the stronger currency. So remember, now we are trying to convert $100,000 to pounds. So you have to decide, okay, will this 100,000 become a bigger figure or will it become a smaller figure? Think about it. We are always, now we are in Sri Lanka, no? We are always the weak currency. We are always the weak currency. So when we convert our rupees, let's say we are converting it to dollars, the amount of dollars that you get is always going to be less. Right? So the weaker currency, in terms of numbers, it will always be a bigger number. Okay, it will always be a bigger number. The stronger currency, in terms of the monetary number, it will be a smaller number. So if you want to convert one number to another number and you want it to become smaller, then you can't multiply this by 1.7832. You have to divide it. Only if you divide it, you will get a smaller figure. So 100,000 divided by 1.7832. So that should give you 56,079 pounds. Okay. So if we enter into a forward market hedge, then what will happen is, for the receipt in 1 month of 100,000, when we convert it, the bank will give us 56,079 pounds. That is fixed. Okay. So be careful with two things here. Okay. First thing is, be careful with whether you have to add or subtract that 0.003. Always remember, you have to think about what the bank is doing. Now we are selling, correct? Okay, but we are not concerned about what we are doing. We have to always consider what the bank is doing. So if the bank is buying, they will always buy at the higher rate. First thing. Next thing is, it might sound very straightforward now, right? Obviously, 100,000 divided by 1.7832. But at your exam, trust me, they will never give you dollars or pounds. They will give you some weird currency. They will say La La Land, or some fence company. It won't be a currency that we already know about, because now dollars, pounds means we always know pound only has to be the lower figure when we convert it. Okay, but it won't always be currencies that we know. Okay, so that's why it's always important for you to decide which currency is stronger, decide how the number should be. Will it be a bigger number or a smaller number, and then decide on the multiplication or division. Okay. Right. So we have done for 1 month. You can take this down. And then let's do the same thing for 3 months. The 3 months receipt of 300,000. I'll give you a minute to take this down. Yes, Shan. You have a question? You can ask. Section B, noon company. Okay, so I will have a look at it, not today, but maybe the following week. 1 second, I'll just have a look at it right now. Section B, is it? So I will have a time finding it also. Okay, just give me some time. I will have a look at it and do it if possible. Okay, but not today, because we already have it planned for today. So next week I will have a look at it. Right. You have the answer for 3 months. Correct, Yunus. Okay, that's correct. So let me also do the 3 months quickly. Okay, so in 3 months, what's happening? We are receiving 300,000. Okay, so only receiving. We are not paying anybody anything, so we don't have to net off. Just 300,000. We have to hedge this. So again, we are UK based. We don't want dollars. We will sell it to the bank. Okay, meaning the bank is going to buy. Bank buys always high. Okay, so 3 months forward rate, that's going to be 1.7846. Obviously, bank buys high, so that's plus 0.0004. So that will be 1.7850. Okay. Pound is the stronger currency. So if I'm converting dollars to pounds, the pound figure has to be a lower figure. So I have to divide 300,000. I divide it by 1.7850, which will give me 168,067, like Yunus said. Okay. So I receive 300,000 in 3 months, and when I receive it, I will get, when I convert it, I will get 168,067. No risk, no variability. The figure is fixed. So this is how you can hedge using a forward. So that's it. Since it's easy, you can see you get only 3 marks for that. Okay. Let's look at the C part. Take a minute to take it down and let's look at the C part. Okay, it says calculate the expected sterling receipts in 3 months using a money market hedge and recommend whether the forward market hedge or the money market hedge should be used. So they are talking about this 3 months figure. Okay, so they are saying now if you use the forward market, if you use the forward, then you will get 168,067. That is one method of hedging. Now the question is asking you, suppose you use another method, that's the money market hedge. Then how much will you get? I mean, in terms of pounds, how much will you get for this 300,000 that you receive? And based on that answer, they're saying compare the two and see which one is the better option. Obviously, the better option will be the one that gives us more pounds. Okay, so let's do the money market hedge. Now watch carefully. This is the money market hedge for a receipt. So money market hedge, it's a receipt. Okay. Now what's going to happen in 3 months? In 3 months, we are going to receive $300,000. If we are receiving $300,000 in 3 months, that is an asset for us. Okay, it's an asset. So if you're going to get an asset in 3 months, what you have to do in a money market is today you have to do the opposite. What do you have to do? You're getting an asset now. So you will create a liability. Okay. You will create a liability today because in 3 months you're going to receive $300,000. That's an asset. So today you will do the exact opposite and create a liability. How do you create a liability? You basically take a loan. Okay, so you borrow dollars. You borrow a loan. Now, if you look at the dollar interest rate, borrowing is 5.4%. Now, we're talking about $300,000, right? So, we borrow dollars. Interest rate is 5.4%, but this is a yearly rate. Okay, so we will borrow at 5.4%, but again only for 3 out of 12 months. This is a monthly rate, sorry, yearly rate. So 3 out of 12 months only we will borrow. Now, the amount that you're getting in 3 months time is 300,000. So we don't borrow 300,000 exactly. We always think about time value of money. Okay, so we will borrow the present value of 300,000. Okay, so how do we get present value? Basically, it's going to be 300,000 into, you have this equation you should be familiar with, 1 over 1 plus r to the power n. So here 1 plus r, the rate is going to be 5.4 into 3 over 12. So that will be 1.35%. To the power n, you don't need to put n because the r is already a 3 monthly figure. Okay. So 300,000 into 1 over 1 plus 1 plus 1.35%. So the amount that you actually borrow will be 296,024. Okay, that's the amount that you borrow. Uh, 169, yes, correct, Yunus. Okay, money market hedging, it is that. That's the amount. I can't understand what you're saying, Shan. Madam, if we take 3 over 12 as, what do you mean? Okay. So we borrow the present value of 300,000, which is 296,024. Now this amount is there in our hand. Now again, we are a UK based company. We can't do anything with dollars. Okay. So what do? We sell it. Okay. So let's sell these dollars. Today we have this in hand. Let's sell them. Okay. So when you sell to the bank, obviously you have to sell it to the bank. The bank is buying. So bank buys high. Okay, so today, no. So we have the exchange rate today, no problem at all. Spot rate. Okay, so what is the rate that we will sell at? We will sell it at 1.7820 plus 0.0002. So ultimately, we are going to sell it at 1. How much is that? 1.7822. Okay. So when we sell it, we have dollars. We need to convert it obviously to pounds. So 296,024, you divide it by 1.7822. Let me write it as well. 296,024 divided by 1.7822. So now in hand, you have how many pounds? 166,089 pounds in hand. Okay. It's there in your hand. Obviously, no company will keep money in their hand just like that. So when you have the pounds, what will you do? You will go ahead and deposit the pounds. Okay. You will deposit the pounds. And if you look at the sterling interest rate, the deposit is 4.6. So the rate you will get is 4.6, but that's the yearly rate. You will only deposit for 3 months, 3 over 12. Okay. So 166,089, it will grow at 4.6 into 3 over 12. So 4.6 into 3 over 12, the percentage we are talking about is 1.16%. So this is the percentage 166,089 will grow at. Okay, so let's see how much we will end up having in 3 months' time in the pound account. 166,89 into 1.16% now. So that is going to be 1.0115. Actually, it was 1.115. Okay. So this pound that you had deposited, it will become 167,999. Okay, it will become 167,999. So this pound amount is there in your pound account. Okay, so it's there in your bank. Now, in 3 months' time, what will happen? You will get 300,000 from your customer. What you will do is, you will use this 300,000 to settle the loan that you took, the dollar loan that you took, 296,024. Now that also interest will keep adding up. Okay, interest will keep adding up and that loan will become 300,000 because the interest rate is anyway 5.4. So then what will happen? This 300,000 that you have to pay the bank for a loan that you took, you will pay it using what your customer gave. Okay, so a dollar loan will be set off with the dollar payment itself. But what will happen? The amount in the pound account, you can already decide today itself, 3 months ahead. 3 months ahead itself, I can say in my pound account, I will have 167,999. So I don't have to worry about the exchange rate or anything. This is the amount I will have in 3 months' time. Okay, but the liability that I have created, I will set it off from the asset that I will receive in 3 months' time. So now you have to compare this amount because finally the amount in your pound account is this. In the sterling account, you have 167,999 for the transaction. So if you have to decide whether I'm going to go for money market hedging or for the forward, you have to compare the two figures. Forward, you're going to get 168,067. For the money market, you're going to get 167,999. So obviously, the forward gives you more pounds. So you will go for the forward market. You will go for the forward. You will not hedge this 300,000 receipt using money market hedging. You will go for forward market hedging. So make it a point to write it because that will also carry a mark. They are asking you, recommend whether a forward or a money market should be used. Okay, so this is how you will do money market hedging for a receipt. Okay. 1 over, no, it won't be wrong. Okay, it won't be wrong, but you have to put it properly in the cal. Okay, so if you don't put it properly in the cal, what will happen is you will end up getting the wrong answer. So it's better to put 0.054 into 3 over 12, get the percentage, and then insert it into the present value fraction. Okay. And yeah. Oh, yeah. Sorry. I thought you had put a multiplication sign here. Thank you, Yunus, for pointing that out. This has to be multiplied. Okay. If you put it to the power 3 over 12, then chances are that it will be wrong. Okay. Because in that 1 over 1 plus r to the power n is a yearly figure. Okay, Chan. So I understood your question now. You're saying because I'll come back to this if you haven't copied it, guys. I'll just answer Shan's question. So your question is this. This is the equation of 1 plus r to the power n. So you're saying instead of taking the percentage 1 plus 5.4%, which is the yearly rate into 3 over 12. Don't do that, right? Because n is a yearly rate. Okay, so if you put 5.4, then you can make it 1 year, 2 year, 3 year. That is the present value. We don't have a monthly rate or anything like that. So the best option is for you to convert this to the monthly rate and forget about the n. Okay, don't mix it up with the n. It will confuse you. Okay. So if you really want to put everything in the same fraction, then it will be 5.4%. And like Yunus said, it will be 3 over 12 over here itself. But then as you can see, it becomes a little long. Okay. Right. So for those of you who want the money market hedge, this is that. You can take it down if you want to. Right. Then the D part says, discuss how sterling currency future contracts could be used to hedge the 3-month dollar receipt. So they have spoken about the forward. They've spoken about the money market hedging. Both they asked you to do the calculation. If you can see 5, 6, 7, 8 marks have been given just for forward market hedge and money market hedge. Now the last type of hedging also they're asking you, not the last, we have options as well, but they're asking you for about currency futures. So they're asking you, how will you do this hedging if you were going to use currency future contracts? Okay, and they're giving you 6 marks for that, right? So when you see 6 marks, first you have to realize that you have to make about, now because we are talking about futures and all, you have to make about 4 good points. Okay, about 4 good points. So you can probably explain what a future is. You can maybe give a few features of futures. For example, if you remember, they are standard in size. Okay, they have a standard size of $62,500. They have a certain date in which the contract closes. So those are all theory things that you have to just brush up on. So you can talk a little bit about the futures, and then we can relate it to this question. Okay, so let me show you the marking scheme, so it will be easier for you and you'll be able to understand what they are expecting. Okay, so this is about page, just guessing. Okay, yeah, show you the marking scheme quickly for this. 531. Yeah. Okay, so look here. So they're asking for that company, how are they going to do the futures, right? So see, it's by the way, in your marking scheme, you will see some areas highlighted. So those are the areas that you have to focus on. If they see that, they will immediately give you 1 mark. Okay. So it says a currency futures contract is a standardized contract for buying or selling of a specified quantity of foreign currency. So if you say that a futures contract is a standardized contract, that will give you 1 mark. And then you can say it's traded on a futures exchange and settlement takes place. You don't have to say 3 monthly cycles and all. You can say March, June, September, and December. Okay. And then you can say the price of the futures is the exchange rate for the currency specified in the contract. So the price of the future, it will be specified by the exchange itself. Okay. So I know the third point you might not have thought of, but the first two, that is that it is standardized and it ends in this March, June, September, December, definitely you can write. Okay. So all this you can read, guys. Okay. If you read it, you will get a good understanding of how a future works. Let's just talk about the marks, right? Because they don't expect you to write this. That's why it's not highlighted. They're writing it so you can read and learn from it. Okay. Then it says most currency futures contracts are closed out before the settlement dates by undertaking the opposite transaction to the initial futures transaction. You might not be able to say that also. Okay. But you can say this. A gain made on the futures transaction will offset a loss made on the currency markets and vice versa. So that point you know, right? So you can go ahead and write that. Okay. So you can say if you enter into a futures transaction on the settlement date, that is in 3 months time, we expect, now for example, you can say if the currency exchange resulted in a loss, you expect the futures transaction to result in a gain. Okay. So the futures transaction and the currency market both will cancel each other off. So saying that will give you a good 2 marks because that is the main concept when it comes to futures. So we got 2 marks here and 2 marks just talking about the gain and loss. Then look at this. They are talking about this company. Okay, so 4 marks for general stuff. The remaining 2 you will get only if you talk about that particular company. Okay, so it says Nedwen company expects to receive 300,000 in 3 months and so is concerned that the sterling might appreciate against the dollar. Okay, so Nedwen's problem is that if you are going to get $300,000 and if the pound becomes stronger than the dollar, pound becoming stronger is good for his country, but it's not good for him. Okay, because if the pound gets stronger, then the actual amount of pounds that he receives in his hand will be less than what he would receive if he did it today. Okay, so that is his problem. So how will he hedge this using a futures? They can hedge the receipt using sterling futures as follows. Carefully watch. As Nedwen will be buying sterling in June. Okay, so today they said it's April. So 3 months time in June, what will happen? You will get dollars and obviously you will sell the dollar and buy pounds. So in June, you are going to buy pounds with the dollars it receives from the customer. what you will do is at that time, you will do the opposite. You're buying sterling in June, no? So you will sell sterling futures in June. Okay, so the actual transaction, if you're buying, then the futures transaction, you will sell the opposite. Okay, at the same time, so that any movement in the exchange rate is offset by the two opposite transactions. Okay, if you stop at that, you will get a good 6 marks. Okay, so let me just explain the last part again. In June, in 3 months' time, you are going to get dollars. Okay, so if you get dollars, now since we are in UK, we have to talk about buying and selling sterling or buying and selling pounds. We can't talk about buying and selling dollars, right? So when we get the dollars, what will happen? We will use those dollars and buy pounds. So if you're going to buy the pound in June, then the futures contract, it has to be the opposite. So you have to sell in June. Okay, so if there is a profit that you're making from buying the sterling, it will be offset by selling the future. Okay, so if you gain one, you will lose the other one. If you lose in one, you will gain in the other one. So that is how they will both net off. Okay, so if you can make those points, you will get those 2 marks. Okay, so this is exactly how the marking works. Definition of a futures, 1 to 2 marks. Initial margin, variation margin, if you're really good, you can see they're talking about 8 marks, right? So don't, just read it. If you can understand it, fine. If not, don't worry too much about it. Then you can talk about buying and selling of the contracts. That will give you 2 marks. You're telling that it will, set off each other. Hedging the 3-month receipt. So like I said, 4 marks is going to be general. But the other 2 marks you will only get if you talk about that company. Okay, so then you will get the 6 marks totally. Okay, so the others also I'll just show you. Evaluation of the money market hedge. So the calculations you get 4 marks. Comment to say that you're going to go for the forward, not the money market. That is 1 mark. Okay. B part, for netting you get 1 mark to know that in this question. Okay, here for you to know that you have to do the deduction and only do the forward for 100,000, you get 1 mark, and the other 2, you get 1 mark each. And here also, like I said, 2, 2, 2 for each of the types of risk. So now, for example, in a situation here for transaction, you start writing for 6 marks just for transaction risk, you won't get it. Okay, although there are 6 points talking about transaction risk, the maximum you will get for transaction is 2. Okay, so always if the question is 3 part, at least write one point for each of the type of risk. Don't try to explain one risk too much because that also won't give you the mark. Okay. Right. So has this question been clear so far? We are at 8. The last question that we will do is to do with NPV. Okay, so the last question will be to do with NPV. It's a question called, let me check the name once more. Degnis Company. So that is page, on your revision kit, it should be on page number 139. So this is an NPV based question. I'll give you some time also because most of you must have, since it's the first area of the syllabus that we cover, you must be good at it. So I'll give you a minute. If you are comfortable, you can try it out and then I will start. Okay, so I'll give you guys a head start of maybe 5-10 minutes and then I will start. 139. Yeah, this one, June 16. I'll see if I can, wait a minute, I'll just check if I can, yeah, enlarge it. $167. Okay, that's better. So this is the question, Degnis. A part, the requirement is saying calculate the expected net present value of the planned investment for the first 4 years of operation. So based on all the information that you have here, you have to calculate NPV. So this is again on page number 139 on your revision kit. If you have the Kaplan revision kit, you can go ahead and have a look at it. So I'll give you a head start of maybe 5 minutes and then I will also work on it. Okay. So it's a very comprehensive question. Have a go. Yes, I hope at this point you have some idea of, how to go about this. So let me read it, okay? Degnis Company is a company that installs kitchens and bathrooms to customer specifications. It is planning to invest 4 million in a new facility to convert vans and trucks into motorhomes. Okay. So it's like a new business that they're trying to start, right? Where, there's a trend, right? Not in, obviously not in this part of the world, but in the West, where people try to live in vans. Okay, so what happens is you have a room, you have a kitchen, you have washroom, everything inside the van. So you can basically travel and you don't have to, stay in hotels or anything like that. So there's a trend like this. So this company, they are trying to diversify and, enter that business as well. So it's saying there, each motorhome will be designed and built according to the customer requirements. Okay. Degnis company expects motorhome production and sales in the first 4 years of operation to be as follows. So they're expecting to produce and sell in year 1, 250 homes, 300 in year 2, 450 in year 3, and 450 in year 4. That's the number of vans or trucks they are hoping to sell. Okay. The selling price for a motorhome depends on the van or truck which is converted, obviously, the quality of the units installed, and the extent of conversion work required. So if you're taking a truck that is, already very long and, it's easy for you to just insert, put in the kitchen and stuff, probably the cost will be low. But if the truck is, in a condition where you have to do more work on it, then obviously conversion work is high, so you will have to pay a higher price. Degnis company has undertaken research into likely sales and costs of different kinds of motorhomes, which could be selected by the customers as follows. Okay. So they said the price of the motorhome depends on the type of motorhome also. So they're saying you can have basic, you can have standard, you can have deluxe. So if it's basic, the selling price will be 30,000. If it is standard, it will be 42,000. And if it's deluxe, it will be 72,000. And they're saying that 20% of the people will go for basic, 45% will go for standard, and 35% will go for deluxe. Then they're saying conversion cost, if it's going to be the basic type, then you might have to have $23,000 you have to have for conversion. If it is the standard, then it will be 29,000. If it's deluxe, then you will have 40,000. Then it's saying fixed cost of the production facility are expected to depend on the volume of motorhome production as follows. So selling price, conversion costs are obviously variable. It will change with the number of units that you produce and sell. Whereas there are fixed cost also, but they are saying fixed cost in thousands. If you produce 200 to 299 trucks or vans, the fixed cost is 4,000 or 4 million actually. It's in thousands, okay? 300 to 399 if you produce, then the fixed cost is 5,000. And 400 to 499 if you produce, it will be 5,500. Fine, we have the fixed cost as well. Degnis pays corporation tax of 28% per year, with the tax liability being settled in the year in which it arises. So year 2's tax will happen in year 2 itself. You will settle it. Okay. The company can claim tax allowable depreciation on the cost of the investment. So what is the investment? 4 million. So on this 4 million, they can claim tax allowable depreciation on a straight line basis over 10 years. This is important, right? When it comes to NPV, there will always be an adjustment for tax allowable depreciation. Degnis evaluates investment projects using an after-tax discount rate of 11%. Okay. So let me start. They're asking for NPV of the investment for the first 4 years of operation. Now guys, remember, if you're trying to calculate NPV, you should first have all the cash flows of that particular investment. So what are the cash flows? Selling price. Okay, so selling price, the sales revenue, that's a cash inflow. Conversion cost is a cash outflow. Fixed cost is a cash outflow. Then we are paying corporation tax, that is a cash outflow. And tax allowable depreciation will result in something called a tax savings. You'll have a tax saving. So if you remember, I will show you how to do that calculation. This is straight line basis. So that will be a cash inflow. So let's get all the cash flows first. First, let's calculate the sales revenue. So I've just copied the question here. We have basic, standard, deluxe. The probability to go for basic is is 20% probability. The probability to go for 45 for standard is 45%, and probability that people will go for deluxe 35% will go for deluxe. Okay. Then we have the selling. I got a little confused because usually selling price will be $12, $13, right? But in this case, it's big. That's because they have vans and trucks that they're converting. Okay. So selling price per unit, it is going to be 30,000 if it's basic, 42,000 if it's standard, and 72,000 if it's deluxe. Conversion cost also, we have the three figures. Now, first things first, we can't do NPV with three different models like this, basic, standard, deluxe. So first, we have to get the expected value or the average selling price. So let's do that. Average selling price. So how do we get that? It's going to be 30,000 into 20% plus 42,000 into 45% plus 72,000 into 35%. Okay, so let's do that first. So 20% into 30,000, and the same thing you will have to do for everybody, standard as well as deluxe. Okay, so you should get the average selling price as 6,000. You can check. Let me also check if the answers are there. Yeah. So that will be 6,000 plus 18,900 plus 25,200. So these are the average selling prices for basic, standard, and deluxe. So now we need to get the total of this. So let's do that. The price sales revenue that you will get per unit is 50,100. Okay, so usually in the NPV calculation, they won't include probabilities, but here they have included it. Okay, so we have to get the expected value and then add them together to get the average selling price. Okay, so how I did it is the probability into the selling price, and then I did it for basic, standard, and deluxe, and I added the three together. Let's get now average conversion cost. Okay, same thing, but now this time it's going to be 20% into, 20% into conversion cost is 23,000. So for the basic, that will be 4,600. You need to get it for all three. And then you get the total conversion cost, which is these three together, which is 31,650. But remember, both are per unit figures. So let me write that as well. Per unit. So this also per unit. So now I have both the sales revenue as well as the conversion cost. So if I deduct it, I should be able to get the cash inflow, because selling price is an inflow, conversion cost is an outflow. Okay. So now let's start off with the NPV calculation, year 3, year 4. Okay, so we have 4 years. Let's just say produced and sold. Okay. So in year 1, we are producing and selling 250. Year 2, it's 300. Thereafter, it's 450 and 450. Okay. So now, if I want to get the total sales revenue, then I have to take 50,100 and multiply it by 250. Okay. So let me do that. 50,100. Here also it's 50,100. Okay. So total sales revenue that will be this figure into 50,100. So I'll just reduce the size. 12,525,000. Okay. Yeah. Okay. So we have the total revenue for every year. So now let's get the total cost. That will be 31,650 multiplied by 250. Okay. So let me just take this figure, 31,650. You will have to multiply it with 250. Okay. And let's do that for all the years. Okay. You're not able to. Okay. So that's for year 2. And then year 3 will be the same thing. Okay. So we have the revenue and we have the conversion cost. Okay. Let's do this question in thousands. Why I'm telling you that is because if you look at fixed cost, they're saying it's in thousands, right? So for your exam, you won't have any problem if you do everything just using the figures as it is. But here I'm going to do it in thousands because only then you will match with the marking scheme. Okay, because if not, you will do everything and then you look at the marking scheme and get confused. So only for that reason, I'm going to do everything in thousands. Okay, so let me just quickly change these figures because they're too big. Okay, even for your exam, you can just do everything in thousands if you feel the numbers are too big. Right. So, okay. So let me just change this to 50.1. That should help. Okay. And then this figure, let's change this to, I can make it 0. Okay, I'll just write the figures, okay, because I don't want to confuse you. This is the figure. In thousands, it will be 7913. Okay, this will be 9495. This will be 14,243. And this will be 14,243. Same. Okay. So let me just take this line off. Okay, and put these figures in. Again, I'm telling you, you can put the big figures, no problem. I'm just doing this because I want it to match with the marking scheme. Okay. So now we have the total revenue and we have the conversion cost. You can deduct the two and get a figure called contribution. Okay, why? Because it's selling price minus the variable cost. So that is the contribution, 4,112 for year 1, and you can get all the years. Okay. Right. So now let's deduct the fixed cost. So what does the question say? Fixed cost of the production facility is expected to depend on the number of motorhomes produced. So in year 1, we have produced 250. So that is between 200 and 299. So that should be 4,000. In year 2, we have produced 300. So that is between 300 and 399. So it should be 5,000. In year, in year 2, yeah, 300. Year 3, we produced 450. Year 4 also 450. So for those 2 years, the fixed cost should be 5,500. Okay. So now we have the fixed cost as well. So what we can do is we can take a total here saying before tax cash flow. So before we do any tax adjustments, we can take a total. So that will be the contribution minus the fixed cost. Okay, so that is 612 over here. And you can get it for all the different years. Right. So now we have dealt with until this part of the question. Okay, so now let's do the tax. They are paying a corporation tax of 28% per year. So tax at 28%. And they are settling it in the year in which it arises. So these are the cash inflows, 612. So on this 28% tax, you're paying it on that year itself. So no problem at all. Here it will be 28% of this figure. Okay, so the tax liability will be 171. Okay, so it will be 171, 149.8, 784.56, 794.56. Okay, so that is the tax. Now comes the tax allowable depreciation. So we have to adjust for this tax allowable depreciation. So let's do that a little down. Okay, we can call it even a working. So let me give some space for the NPV and do the tax allowable depreciation here. So what does it say? The company can claim tax allowable depreciation on the cost of the investment on a straight line basis over 10 years. So what was the cost of the investment? If you see right on top, it says we are investing 4 million. Okay. So we are investing 4 million, 1, 2, 3, 4, 5, 6. Okay. And they're saying we can claim tax allowable depreciation on a straight line basis for 10 years. So what we have to do is this 4 million, you will divide it by 10. Okay, so that should give you the tax allowable depreciation as 400,000, obviously. Okay. Okay, so 4 million divided by 10. Sorry. Remember, this 400,000, this is the tax savings. Okay, this is the tax savings. So on this 400,000, you have to multiply it by your tax rate, which is 28%, and get the tax benefit, which in this case will be 112,000. Okay, so if you're not familiar with how this works, you have to go back and see how we did tax allowable depreciation adjustments. Okay, so it's basically like this. If you have an investment of 4 million, I'll explain it to you quickly. If you have an investment of 4 million, now we are investing it now. In accounting, when we do financial reporting, usually we are allowed an expense called depreciation. Okay, so we are allowed to deduct something called depreciation in our accounts. Okay, but the tax authorities, they don't allow us to, recognize depreciation at all. So what they allow is something called capital allowances or tax allowable depreciation. Okay, so what is this tax allowable depreciation? It is basically the equivalent of depreciation, but for tax purposes. Okay, so why are they doing this? Because depreciation is something that we can manipulate, right? We can say straight line, we can say reducing balance, and we can manipulate it. So if you manipulate an expense, then what happens? You can, reduce your tax liability. So to avoid that only, they tell you how to calculate this capital allowance. So you can't manipulate it at all. So this 400,000 is like depreciation. It's like an expense. So what happens is, when you deduct this 400,000 from your taxable profit, you actually make a savings because the total profit that you're paying tax on, it becomes smaller. So the tax savings that you're making, you have to add it as a cash flow in your statement. So you don't have to know anything of what I said. Okay, because all of that is covered in the tax paper. Okay, for FM, what you need to know is, if it is straight line method and you want to make the tax allowable depreciation adjustment, it's going to be 4 million divided by 10. That answer multiplied by the tax rate. If it is reducing balance method, don't worry. We will do a question on that as well. It will be 4 million into the reducing balance rate. That answer into the tax percent. That's it. Okay, so it doesn't change much. You just have to take the answer that you're getting for tax allowable depreciation, multiply it with the tax rate. Okay, so in this case, that will be 112,000. Since we're doing the question in thousands, you should 112 in the 4 years. Okay. Right. So have we done all the adjustments? Let's look at the question. We had all the selling prices, conversion costs are done, fixed cost is done, everything to do with tax is done. We used all of this information. The only thing we have to include is the investment of 4 million. Okay, so let's write that as well. Investment. That is going to happen in year naught. Okay, so, okay, that's becoming that. So write it like that. Okay, year naught, it in thousand, so say 4,000. Okay, right, flow. So let's take the after tax cash flow. Okay, here it's going to be the same. In year naught, it will be the same. Here, it's going to be it because tax is obviously something that you have to pay plus tax allowable depreciation. Okay, because this is a saving. So this will be added. That will give you 553. So let me just say, I'll change this a bit so you won't get confused why I added that. I'll call this tax savings on tax allowable depreciation. Okay, so that's why we added the 112 and deducted the 170.36. So the same thing we have to do for all the years. Okay, so after tax cash flows is done. Lastly, we have the cash flow. We have to discount it at the discount rate of, they tell us how much. After tax discount rate is 11%. Okay, so you have to go to your tables, go to 11%, and you have all the figures. For year one, it's 0.909, 0.812, 0.731, 0.659. Sorry. Okay, so always year naught will always be 1. Here it's 0.909, 0.812 from the tables, 0.731, and 0.659. Oh, sorry. Wait a second. It's all rounding up. Okay. Okay. 659. 731. Yeah. This has to be 659. Right. So now we have the cash flows. If you multiply it with the discount factor, you should get the present values at 11%. Okay. So that will be this into 1, this case 4,000. And then you can have it for all the figures. Okay, so 498, 404, 1,557, and 1,403. Present values at 11%. Now, if you want the net present value, that will be all these figures added up together. So, this minus 4,000 plus 498 plus 404 plus 1,557 plus 1,403. So the NPV is a negative 138. Okay. So here itself say, since NPV is negative, the project will be rejected. Okay. So if you say all that, you will get 7 marks. Whenever you calculate NPV as a habit, say if you're going to accept it or reject it, because sometimes you'll get 1 mark, sometimes you won't. But if you miss it, you might lose 1 mark. 1 mark is very precious. Okay. Right. So hope that is clear. This is one type of question for NP. Any questions? Anybody, any questions? Is it clear? Yes, so you can take it down. If you need any area for me to scroll or anything, let me know. Okay. Okay. So tax allowable depreciation, it can come in two ways. Okay. One, you can have the straight line method like here, or there's another method called the reducing balance method. So learn the straight line method here, where you take the investment divided by the number of years they're telling you to. In another question next week, we will do it using reducing balance. So then you will know how to do both. Okay. Right. So I hope that is okay. Let's move on to B. Okay. So it says in B, after the fourth year of operation, Degnis company expects to continue to produce and sell 450 motorhomes per year for the foreseeable future. So that means in perpetuity, they are expecting to produce and sell 450 motorhomes. The requirement is calculate the effect on the expected net present value of the planned investment of continuing to produce and sell motorhomes beyond the first 4 years and comment on the financial acceptability of the planned investment. Try to read that and try to understand what they're trying to ask you to calculate. They're asking you the expected NPV beyond the first 4 years. Now, for the first 4 years, we have calculated NPV. We are saying it's negative. Don't go for the project. But now, see, there can be a situation like this, right? Some projects, for example, this project is a good example for that. See, in year 1 and 2, we are only selling 250, 300. But year 3 onwards, we are forcing a sale of 450, which is a big amount probably. At least much bigger than 1 and 2. So sometimes if you calculate NPV only for the first few years, it might be negative, but later on the project might be profitable. Okay. So to avoid this problem, you have to calculate NPV for a long period of time. Okay. So here they are saying first 4 years it's negative. Yeah, we know that. But if you calculate the same NPV, we are saying we are going to sell 450 motorhomes every year until perpetuity. So they're asking you, calculate NPV for the remainder, the remaining, 4 years and above. Calculate NPV and see what that is showing. Is it positive? That is their question. How do you think you can do this? I'll give you a few minutes. Try to figure out. So how you should do this is, basically you should get the cash inflow. Okay. And see if there's any other cash flow that you have to consider, and then you can discount it. It's like a perpetuity. You can discount it. Okay. So I'll give you a minute. See if you can figure out how this should work. This is a good question, guys, by the way. Any ideas on how you can do this? Let's look at our cash flows. Okay. Now we have to figure out from year 5 onwards. Okay. From year 5 onwards, we want to know what is our cash flow. Okay. So we know that before tax, year 3 and year 4. Okay. Year 3 and year 4, the sale was 450. We produced and sold 450. And all these figures won't change after that. Revenue, conversion cost, fixed cost, those won't change. Okay, if it's 450, then year 5, 6, 7, 8 until perpetuity, the cash flow before tax will be 2,802. Okay, and if we assume that the tax rate is also going to be 28%, then the cash outflow without the savings on tax allowable depreciation, that will be 2,802. Okay, 1 second. It will be from year 5 to perpetuity, we're talking about. It will be 2,802 minus 784. So let's just call it 784. So the cash inflow, it will be 2017 per year. Okay, it will be 2017 per year. Now we have to think about tax allowable depreciation as well. Okay, we have to think about tax allowable depreciation. All right, no, let's not think about that right now. First, let's figure out all of this and then let's go to the tax allowable depreciation. So let me draw a number line to show you what's happening here, okay? Year 1, year not actually, to year 4, we did the NPV calculation and we found out what's happening, okay? Now, year 5 onwards only, we are saying we are going to get 2017. So we did everything in thousands. So I'll just put the full figure. 2,17,000 we are going to get every year until infinity for perpetuity. Okay. So if I were to calculate NPV, or if I have to make this 2017 a present value, then I have to multiply this by something called the perpetuity factor, if you remember. Okay, because this cash flow, it's happening from year 5 onwards forever. Okay, so if I have to convert this to a present value, then what I have to do is I have to take the 2,017,000, multiply it by 1 over R, because perpetuity factor is always just 1 over R. The rate is 11%. Okay, so if I do that, when I put that in my cal, I will get 18, sorry, let me check how much that is. So that is 1 over 11% into 2,017,000. Yeah. I will get 18,336,364. Okay, 18,336,364. That's the figure. I will get the present value of the perpetuity. But remember, whenever you multiply with a perpetuity factor, discount factor, annuity factor, whatever it may be, it will only bring the value 1 year back. Okay, it will only bring the value 1 year back. So the 18,000 odd figure that I'm talking about, that is what, 18,336,000, sorry, 18,336,363. I'm talking about that figure in year 4. So this is not the real present value. If I want the real present value, this I have to further use a discount factor to make it come to year naught. Only then it will be a real present value. So 18,336,363, I have to multiply it with the discount factor at 11% for how many years? For 4 years. Okay. So discount factor at 11% for 4 years, that will be in your table, you can get it. 11% for 4 years, discount factor is 0.659. So the real present value is 12,083,664. Okay, I know the numbers are long. Again, You can do it in thousands, guys, no problem. Why I'm doing it like this is for you to match with the marking scheme. Because if I don't match it and you write something else and then you go back and refer it, you will get more confused. So I don't want you to get confused just because of rounding. Okay, so that is why I'm using the entire figure. Okay, right. So when we're talking about our cash inflows, okay, we took the tax as well. So we know that excluding this tax allowable depreciation tax savings, the cash inflow for the year 5 to infinity will be $12,083,604. Now let's worry about the tax allowable depreciation story. So if you're talking about tax allowable depreciation, what happens? Okay. If you look at the question, there is that. It says the company can claim tax allowable depreciation on the cost of the investment on a straight line basis for 10 years. Okay. So in this 10 years, for 4 years, the tax benefit, the tax savings, we have already considered it in the first NPV calculation. So the remaining 6 years only we will get this tax savings that we have to calculate. Okay. Right. So what was okay, so this is that. Okay. Right. So we get the benefit for a remaining 6 years. So 6 years of benefit. So if it's a fixed benefit, can you see the benefit is fixed at 112,000. Fixed benefit for 6 years. The period is also fixed. This is an example of an annuity. Okay. So this 112,000, I'll draw this also on a number line to show you what happens. Year 0 to year 4, we have already worried about it. Year 5, year 6, year 7, year 8, year 9, year 10. Okay. So every year, okay, year 10. Every year from year 5 to year 10, we are going to get this $112 worth of benefit. Every year you're getting it. So what do we want to do? We want to get the present value of this 112. So 112,000 you multiply because it's happening every year. It's an annuity. So annuity factor at 11% for 6 years. Okay. So that will be 112,000 into the annuity factor 11% 6 years is 4.231. So that will give you 473,872. Again, remember discount factor, annuity factor or perpetuity factor. It will only bring the value back by 1 year. Okay, it will only bring the value back by 1 year. So if we want to get the actual present value in today's terms, then this answer, now 473 is here. This you have to multiply it again with the discount factor at 11% for 4 years. Only then you can bring it back to the actual present value. Okay. So 473, 872 into discount factor 11% for 4 years will be, let me check. Yeah, 0.659, which is going to be 312,282. Okay. So the cash inflow, we had a net present value of how much? Cash inflow, we had a net present value of 12,083,664. Present value. Okay, not net present value, just a present value. Then for the tax savings also, we have a present value of 312,282. So if we want the net present value for those remaining 6 years, then you have to add these two figures together. So that will be 12,082,664 plus 312,282. Okay. So both together, you will get an NPV of 12 395,946. It's positive. Okay. So if you see, when we did the NPV only for the first 4 years, we actually made a negative figure. It was negative 138, right? That's what we said. And we said it's negative 138, reject it. 138,000. So 138,000 negative, we're saying reject it. But look at the NPV for the remaining 6 years. It's 12,395,946. Okay. So what we're trying to say is it is negative, but if you consider just the first 10 years, then it's going to be a strong positive. Okay, because even if you cancel each other off, the positive is much higher. So maybe the first 4 years you're going to run on a loss, but thereafter you will start making big profits. So based on that, you can go ahead and accept the project. Okay, so that will be the question asked you for what did they say? They say comment on the financial acceptability of the planned investment. So the comment will be, yes, the first 4 years we're saying it's negative. So we have to reject it based on that. But if you look at the remaining 5 years, it's a strong positive NPV. Okay. So based on that, you can go ahead and accept the project, because in the entire life, or I mean, not the next 10 years, in the entire life of the project, it will be a profitable project. Okay. So that's what you have to say for the B part. Right. So take this down. When you're taking it down, take the timelines as well. Okay. Because a lot of students have this problem after doing all this, they only give 3 marks. Yes, Shan. That is sad, I know. But yes, they only give 3 marks. So yeah, so take it with the timeline, because you have to know what's happening, right? From year 5 to infinity, you're bringing it only to year 4 by multiplying with the perpetuity factor. Thereafter, you have to multiply it with the discount factor to come to year 0. Okay. Right. So those are the questions. C and D is obviously theory based. Okay. So I hope you've taken the perpetuity down. Take for tax allowable depreciation as well, which is an annuity. Okay, so I hope this is also done. Right. Then it's saying, critically discuss the use of probability analysis in incorporating risk into investment appraisal. And they're asking you, here they actually use probability analysis, right? They're asking, risk in investment appraisal is basically the amount that you calculate as NPV. Okay. The probability, or sorry, it's the problem where the amount that you calculated with NPV, it can change. That is only risk. So why will it change? Only if the person who is coming and buying from you, if they're only going for basic, or only going for standard, or only going for deluxe, then it's going to be difficult for us to, kind of forecast properly. Okay. Because now, say for example, we did our entire calculation just based on the basic figures, 30,000 and 23,000. Whereas in real life, somebody's coming, I mean, more people are going to ask for standard, or more people are going to ask for deluxe, then the NPV calculation is going to have, it will be subject to variation or variability. Okay. So by incorporating these probabilities, we have to some extent reduced our risk. Okay. So let's see how this answer looks like. Okay, it's only 5 marks. Even if you just explain risk a bit, explain probability analysis a bit, you will be able to gather at least 3. Now see guys, when it comes to theory-based questions, there are 2 types. One is where you must try to score the maximum. Okay, an example for that is D. I'll tell you why. Because those kind of theory questions, in your syllabus itself, there is a lot of points to talk about. But there are other types of theory where, like in this question, we are not sure exactly what to say. So in situations like this, try your best to just define risk, define probability analysis, and then just try to relate it a bit, because don't waste time too much with something you can't write. Whereas D, on the other hand, you have enough points to write. So that it's an example of where you can, directly write as much as you can and get the 5 marks completely. So let me show you the marking scheme to see how it looks like. This is 168. I hope I don't forget it. Write it down somewhere. Okay. So the marking scheme will be in somewhere around page 400. We'll see. 368. Okay. So look at this. The question was asking you, I'll read the question since it's not here. 1 second, give me a minute. $139. Okay, so the question said, critically discuss the use of probability analysis in incorporating risk into investment appraisal. So see how the answer is structured. First, they're just defining what is risk. They say risk in investment appraisal refers to a range of outcomes whose probability of occurrence can be quantified. That is only risk, no? Risk is quantifiable. The other one is uncertainty. Uncertainty you can't quantify. Okay. So first is they're saying variability of outcome and the probability of it happening, you can quantify it. That will give you a mark easily. Then it's saying risk can be distinguished from uncertainty in investment appraisal, where in uncertainty, the likelihood of it occurring, of particular outcomes occurring, it cannot be quantified. So if you just say risk versus uncertainty, what it is, that is itself giving you a mark. Then it's saying, as regards to incorporating risk into investment appraisal, probability analysis can be used to calculate the values of possible outcomes and their probability distribution. Okay. For example, the value of the worst possible outcome, its probability, and the probability of the investment will generate, and the way. For example, the probability of the, wait, I'll read that again. Probability analysis can be used to calculate the values of possible outcomes and their probability distribution, the value of the worst possible outcome and its probability, the probability that an investment will generate a positive NPV, the standard deviation of the possible outcome, and the expected value of the NPV. Now, guys, I know that you can't write that. Okay, so what it's trying to say, I'll explain what it's trying to say. It's saying if you're using probability analysis, then you can have a percentage for the worst possible outcome happening and a percentage for the best outcome happening. Consider the two and then get your NPV. That's what we did, like an expected value like thing. Okay, but how many of us are going to think of that in the exam? I really don't know. Okay, but for now, it's a 5-mark question. We have spoken about risk and uncertainty. That should give us 2. Okay, so let's forget about it. If we can't explain it, don't worry too much. Let's see what they're saying after that. They're saying one difficulty with probability analysis is that its assumption that an investment can be repeated a large number of times. Now that we know. When it comes to expected values itself, we say one big assumption is that the same transaction will repeat a large number of times. But the reason why we don't use, now for example, only in this question, they spoke about probability analysis in an NPV question. Usually NPVs, we don't talk about percentages, right? Reason is because in reality, investment projects, you can't repeat again and again. Now that point, you can remember it and write. Suppose you get this probability analysis in an NPV and they say critically discuss using probability analysis in investment appraisal, you can say this. Easily it will give you another 2 points. Okay. Another difficulty with probability analysis is the question of how the probabilities of the possible outcomes are assessed and calculated. How did we know 20%? How did we know 45%? How did we know 35%? That is another problem. We always know about it. We know that that's a problem with probability analysis. So you can write that. Okay. We don't know how to calculate the probabilities reliably. Okay. So how do we do this? Usually by looking at past information. Okay, but then also we are assuming that what happened in the past is going to happen in the future. That also, it's a disadvantage of using probability analysis. Assessing probabilities this way is also likely to be a very subjective process. Okay, so 5 marks, right? If you spoke about risk and uncertainty, you get 2. Then if you spoke about this large number of times, the assumption that it happens a large number of times, and in reality that can't happen, another 2. And if you speak about you don't know how to calculate that percentage for probability, that will easily give you 5 and 6. Actually, you have 6 points without having to worry about this. Okay, so when you're doing questions, assess it like that. Be smart with how you are answering. Okay, so don't waste time on something that you don't know. Something that you can't explain, don't waste time. Okay, there are enough points for you to write that you already know. Okay, always remember the answer that they're giving here, guys. It's a 120 mark answer. So it gives you 20% more information than what you need to get 100 out of 100 for your paper. Okay, so don't get demotivated. Now, sometimes you might read this and not understand what it's saying and get demotivated. Don't do that. Okay, they're not expecting you to write exactly this. Right. Then the last one is saying, I'll quickly go to that page. This is 396. That was 168. Okay. Discuss the reasons why investment finance may be limited even when a company has attractive investment opportunities available to it. So they're asking you, we may have a lot of projects that we can invest in, opportunities. But why will we not have finance to actually invest? Because if there are projects to invest that is giving positive NPV, we should invest. Then only the shareholder wealth will increase. So tell me reasons why somebody in a company might not have money, might not have investment finance. Okay. So first thing you have to think about here is a concept called capital rationing. If you remember, there were 2 types of capital rationing. So what is rationing? We are limiting the amount of finance available to us. So there were 2 types of capital rationing. Can you remember? Hard capital rationing and soft capital rationing. Hard means the company doesn't have control over the limit. Somebody externally is controlling it. For example, the bank. Okay, the bank is controlling the amount of finance that we can borrow, for example. So we don't have enough money to actually invest. Soft capital rationing means external parties are not limiting, but the business itself has a policy to limit the amount of investment. Okay, so those are the 3 points that now when you explain hard and soft, 2 marks each, plus you can, when you just speak about the rationing itself, that will give you another mark. So let me quickly show you this one. Yeah, so it says here, theoretically, a company should invest in all projects with positive NPVs in order to maximize shareholder wealth. 1 point. If investment finance is limited for reasons outside a company, it's called hard capital rationing. If it is limited for reasons within the company, it's called soft capital rationing. So if you can just give one more point, say, for example, you say, this may arise because a company is seen as too risky by potential investors. For example, level of gearing is high. They have a high level of debt. Then that could be a reason why people are not willing to invest. If you give another point for soft capital rationing, investing in all projects with positive NPVs could mean that the company increases in size quite dramatically. Okay, so we might not want that kind of growth, and that is why we are limiting the investment. Okay. Another point that is, you might think of is it may also be limited internally in order to require investment to compete with each other for funds. Okay. So another reason why we can have soft capital rationing is, so if the fund is limited, then only the best investments will be chosen. Okay, because if we have unlimited funds, then we might even go and invest in projects that are not giving us much of a profit. Okay, so after we finish the investment only, we will realize, okay, there is an even better project, but now we don't have money. So to avoid that, we limit the amount of finance, and that will help us to choose the very best projects for our company. Okay, right. So that's it for the day, guys. I'm sorry I took a little more time. I will see you guys next week. Okay, I'm sorry I have another meeting. That's why I have to rush. That's it for the day. Okay, thanks.
We have started the premium plus reporting a couple of weeks ago, starting from the syllabus. Now, they are